Hey guys, this is Andrew for TRENDLINES.com. So I've been working as a professional trader for the past 6 years in Hong Kong on the option market, and I've just started to make some YouTube videos where I want to show you guys all the different tools and techniques that I use at work to make money on the markets. So I mostly talk about technical analysis in my videos because this is for me very important. It's like a survival kit that you guys need if you want to do some trading, at least some day trading. And for long-term investment, it is very helpful to find the entry levels or where to buy the dip. But in this video, I want to talk about what I know the best, which is options, and show you guys what you can do using options to make some nice and profitable strategies on AMC. Let's get into it. Let's recall what is a call. A call and a put. It's the basic two vanilla options that you guys can find everywhere. And so a call is something that is giving you an upside performance for a premium. So for example, this is a payoff of a call. So here you are having a call, guys. Okay, this is a payoff of a call. This is a 12 strike call. I'm going to use the maturity of June because this is the most liquid expiry on AMC. I'm going to show you where you can find all your information. It's here, Yahoo Finance options. All right, guys, this is the best database for options, even for the stock prices. You know, this Yahoo Finance database is very complete. And here it's not even a database, it's just the market data. All right, you have all the market data, live market data for free, guys. I mean, it's close to close, but it's very good to use to build up your strategies. So you select your maturity here, guys, 18th of June. And for example, we are going to check what is the 12 call price. So guys, the price is the mid between bid and ask. All right, bid is the price market makers are buying, ask is the price market makers are selling. If you want to buy, you are gonna probably buy the ask level because you need to lift the offer to get done. But actually, if you put an order between the bid and the ask, you usually have some iceberg orders that are hidden here. This is the option markets, guys. This is the professional market. All right, so it's a market where you need to trade a minimum size of the multiplier is 100, so you need to buy at least 100 shares equivalent. All right, so it's kind of big notionals, but for AMC, which price is actually low, it's okay, it's accessible, so you guys probably can go there. And here you can see that the 12 strike call price for the June maturity is between 120 and 129. All right, so let's say 125. So this is where you find your prices. Then you put your strike price here. I did a very basic spreadsheet, guys, where I can just choose the quantity. Let's say you buy 10 options. All right, so it's 1,000 shares. The price is 1.2. The volatility is 125%. And you have your call price that is like this. Now let's see a put price. So I just checked. The price is the same, guys. So now if you buy puts instead of buying calls, this is the payoff you are having. All right, a put option is a payoff that is giving you money at maturity if the spot price finished below your strike level. This is the formula, max of 0 strike minus spot. Now what you guys are probably having right now is a payoff that is like this. Okay, so you're basically having shares. So let's say AMC is at 10. I'm just gonna round this to 10. Imagine you have 100 shares. So if AMC goes to 30, you make, so you probably have more than this, guys, because AMC is cheap. So let's say you have 1,000 shares. So if AMC is going to 30, you are making 20,000 US dollars. Now, what I want to show you guys is that you can get actually the same kind of performance for lower risk. What is your risk here? Your risk is that on the downside, you can lose 10,000 US dollars. All right, if AMC goes to 0. I know stocks don't go to 0, it's just theoretical. You can lose 10,000, you can make 20,000. Now, instead of doing that, guys, all right, so here I put 0. Now you don't have anything. You can buy 10 call options. So if you buy 10 call options, it will cost you 1,200 US dollars. All right, so this is the money you're going to lose if AMC finishes below 12 on the 18th of June. And on the upside, you're making actually the same money, a little bit less. All right, if we go to 30, you only make 17,000. So okay, so you buy 12 and you're gonna make the same. All right, now you're making 20,000 again if we go to 30, but it costs you 1,400 US dollars. but you cannot lose more than this. Basically, your loss is capped. So this is what is good about call options. You have the same upside performance only until June, of course. So guys, this is a premium you're gonna pay for 3 months, even 2 months. Of course, if you want to keep doing this, it would cost you more. That's why I have a solution for that. You need to finance your premium. All right, this is what professionals do. I'm an option trader, so basically every day I do prices for clients. So clients are asking me, I want this type of performance, and I'm gonna give them what they want. So I'm gonna propose some usually zero premium structure. They don't like to spend money. They prefer to bear some risk. So here, what I would suggest if I was in this situation, I would look at the chart. Go check my video on AMC I did yesterday or 2 days ago. I'm bullish, but I have a support level at 750 that I consider. It's possible we go there, all right? I mean, everything is possible, but it's a scenario that has some not close to zero probability for me. But I don't think we're going to go below that. So what I would advise in this situation, if I have this type of view, I would say, all right, you're not scared to lose any money if we go below 8. So P&L profile that looks like this is actually fine for you, because you only start to lose money if we go below 8. So you can sell some put options, and you buy call options, you sell put options. So basically between 8 and 12, you're making zero. I checked, the 8 put strike has the same price as the 12 call strike. So those two are actually financing each other. I mean, the put you are going to sell is going to finance the call you're going to buy. So basically this is a zero cost trade, but instead of paying money, you take some downside risk below the strike that you can define. If you're not comfortable with 8, you can choose 5, but of course it will be cheaper. So you can do something like this, and here it probably will go 15. The price is going to be 0.6. So the situation is the same. Only you're not making money between 5 and 15, but you're not losing money between 5 and 15 as well. I don't like this one. I think that the 8 put strike is actually better. And here you can see that the maximum loss you can have is a bit lower. We are only at 9,600. We used to be at 10,000. So we're actually losing less money if we go to 0. We don't lose any money if we go above 8. And we are making the same money on the upside. So guys, I just showed you that instead of having shares, and you can roll this strategy, you can do it on June, and if it didn't happen in June, you can do the same with September maturity and then with December. And you can do it, you can roll it to the next maturities whenever the expiry is coming. This is actually what pro traders are doing all the time, guys. We build up strategies and we roll them until they're making money. Be careful with that. The options are a bit complex instruments. I'm going to do more videos where I'm going to talk about options. I'm going to try to show you guys everything we can do. You probably understood that this is very basic. We can do much more complicated and smart strategies. Let's start with something that is easy to put in place and to monitor, because then you need to monitor your strategy. This one is easy to monitor because it's a zero cost, risky. So basically the payoff is quite simple to understand. So once again, guys, this kind of strategy helps you to rebalance your risk instead of having a linear risk like you had with your 100 options. So you can see the difference between that to that. So it's just transferring the risk to the areas where you feel comfortable to bear the risk. So guys, that's it for me. I hope you enjoyed this video, and if you did, please don't forget to click on the sub, like and bell button, so you're gonna be the first to know when I upload anything new. And stay close to shore. I'll see you guys.